Krishnan, Managing Partner, Fund of Funds, NIIF, Ankur Thadani, Partner and Co-Head of India TPG Growth and Rise Fund, Gaurav Kapoor, Head Inclusive Growth and Investments, UK Department for International Development, Harsh Singhal, Managing Director, CDPQ India, Satish Mandhana, Senior Managing Director and CIO, Eversource Capital, and Vivek Pandit, Senior Partner, McKinsey and Company, who's also our moderator. Over to you, gentlemen.
Thank you.
Thank you, Chitapa. Welcome, everyone. It's great to see everyone here today. Let me start by just saying a few things about our panel. We actually have a terrific mix of LPs, GPs, people who are involved with buying businesses, transitioning them, and people who are involved with building businesses. So just as a very quick add-on to what Chitapa had named, Anand, Anand's joining us from NIIF. He's the managing partner of NIIF Fund of Funds. And so in some sense, he represents a bit of an LP perspective. He's been responsible for directing and developing NIIF's Fund of Funds strategy, which is a diversified fund into multiple sectors and strategies with third-party managers. He has over 2 decades of experience across India, Australia, and he specializes in investment management, finance, and consulting. Through his career, he's been involved with many direct and indirect investments across power, roads, healthcare, renewable energy, and real estate. So welcome, Anand. Our next panel member is Harsh. Harsh is the managing director at CDPQ. He's responsible for running the India Investment Program. Prior to this, he worked with the International Finance Corporation, which is a private investment arm of the World Bank, as most of you know. Prior to joining IFC, he worked with BCG and Price Waterhouse, where he worked on a number of topics, including restructuring, M&A, and many operational improvement areas. Harsh is a member of the Chartered Accountants of India, and with that lens, we hope he'll actually take a more critical eye to some of the topics that come. Welcome, Harsh. Gaurav Kapoor. Gaurav has more than 21 years of experience across PE and VC. He's responsible for the inclusive corporate development. He spearheads the British government's $400 million development capital investments in India and the country's relationship with the UK's Development Finance Institution, the CDC group. He's worked with governments in India, state governments, on several initiatives to promote both market reforms and encourage MSMEs and entrepreneurship. He is a strong advocate of ESG investing and the role of data and transparency. I think with Gaurav's presence on this panel, we can be assured that we'll get a little bit of the government into governmental response to climate. Welcome, Gaurav. Ankur Thadani is a partner and the co-head of India's TPG Growth Fund and Rise Fund. He serves on the board of Fourth Partner Energy, API Holdings, Solara Active Pharma, Stellis, RIA Healthcare, and Nova IVF. Prior to joining TPG, he worked with India Equity Partners, focusing on investments in consumer and health sectors. As you probably know, TPG, Rise, and TPG in general have committed a very large amount of capital and raised a dedicated pool of capital specifically for climate funds and for climate transition. So Ankur, with Ankur's presence, we hope to hear more about the opportunities and what it's like to navigate those. So welcome, Ankur. And then finally, we have Satish Mandhana, who I've known for many, many years. Satish is the Senior Managing Director and Chief Investment Officer at Eversource. Satish has played in some sense, a pioneering role in creating scale platforms by being an early mover. Prior to this, Satish was with a very large institutional platform that many of you are familiar with at IDFC. At Eversource, Satish is contributing to actually building out digitally empowered, sustainable businesses that have a significant climate mitigation and adaptation impact through decarbonization and resource efficiency. So Satish has sort of been in the hot seat now for a while and actually trying to originate and build businesses ground up. So welcome, Satish. With that, if I can just ask, I'm going to take the group through just a couple of quick slides to set context for India and where we are. So if we can just put the presentation up. Okay. So the topic of today's discussion is, how PE firms are responding to climate change This obviously covers a wide gamut, both of investment mandates, as well as how their own portfolio companies are responding to increased demands of public shareholders and LPs around transition risk and managing commitments towards decarbonization. Next. Just a quick reminder, the world obviously is attempting, right, as fast as it can to commit itself to a 1.5 or 2 degree pathway. As you can see at the current time, our historical record isn't great, and the actions required to move to a 1.5 degree pathway are likely to be quite severe. Obviously, there are many points of view as to whether, what we can do to accelerate this curve. But as you can see here, our continued growth would leave us in a very precarious situation. The expected outlook is not terrific. A 2 degree pathway requires us to bend that curve on carbon emissions significantly, and the 1.5 degree pathway is obviously being met with many commitments, but over time, but yet somewhat elusive, right, from the point of view of whether we can make this transition fast enough. Next. India is kind of interesting, in the world of pledges, India, as it turns out, with respect to the Paris Agreement, not so much with respect to 2 degrees or 1.5 degrees, but with respect to the Paris Agreement, is actually one of the few countries that is on track, right? And some people will call this well planned. Some people will call it an accidental effort of a bunch of forces that came together around renewable energy. But as you can see, the commitments that India had made was 40% renewable energy. By 2020, we're already at 36%, 33 to 35% lower emission intensity as a function of per GDP. So for per GDP dollar, what is our emission intensity? We are currently at 21%, and some indications are that we should continue to meet that with significant effort and reallocation of capital. And the final one, which is where I think there's probably the most skepticism at this point, or the most difficulty, is carbon sinks. Carbon sinks, of course, will require significant change in how we think about soil quality, how we think about sinks, how we think about capturing carbon over time. Next. It is interesting, even as we're on track to meet our Paris commitment, if you think about India's own ambition in renewable energy, you can see here renewable energy capacity, if you take the 29 to 2030 view, right? Not a 2050 view, but 29 to 2030 view, the ambition is to actually develop roughly 435 gigawatts of renewable energy from renewable sources. What that means practically is adding 10 to 12 gigawatts per year. But the historical basis has been 10 to 12 gigawatts per year. But what it implies that we're going to be adding 3 times that capacity over the next several years. Now, that's clearly an opportunity for people in this group and investors. Having said that, this is a significant hill to climb. Next. One thing we've been spending a lot of time on with a combination of investors and policymakers is what India will look like in 2050. And we are effectively building 2 entirely new Indias over this period. And so you can see whether it's power generation, cement, steel, road transport, all of which requires significant movement on significant additional capacity. We have an opportunity to do it right, sustainably, to avoid stranded assets. But as you can tell, the amount of capital required to build these businesses is significant enough, leave alone doing it sustainably. So there is a huge amount of opportunity ahead of us, and this gives you just a sense for the dimensions. Next. By the way, India's opportunities are across the board. It's not just building infrastructure. If you look at livestock and agricultural inputs and outputs, it may surprise you that in 2019, roughly 20% of our emissions were actually a result of livestock and rice. In a lot in agricultural production, the largest source of which is rice. is not, it's perhaps unsurprising that we have been very inefficient in a sense in our use of soil, in our use of water, and of course, the resulting carbon emission issues with both livestock and rice. Interestingly, India is actually one of the biggest livestock, well, cattle owners, I should say, not livestock, but cattle owners in the world. And a result of that, you can actually see between cattle and buffalo how significant this is. If you compare this to other countries, we are only second to China and the US. And this actually puts particularly, increased pressures on India to address some of these issues in a sustainable way. Next. I don't want to leave this conversation without touching on water, right? We are actually on track to run out of water, right? Within the decade, so between 2030. This gives you a sense for the demand for water in India as is projected, as well as our available accessible supply versus available supply. Now, without getting into a lot of detail here, you can see our single largest consumption in water is in fact ag, right? So even as we think about municipal water, industrial water, wastewater, of course, contamination creates other issues, but this gives you a sense for just how significant an issue this is. In particular, when you talk about water and agriculture, the political mandate and political will to address some of these issues will need to be incredibly high, right? These aren't things that the private sector can do alone. Next. And just to give you an example, right? So obviously the region that is probably the most advanced in terms of opportunities in this space is Europe, given its regulatory environment. Just to give you a sense, by 2030, we're projecting Europe will require about 28 trillion euros of additional capital, right? Of that 28 trillion, 23 trillion will have to be redirected, which means all new capital in areas that have yet to be built in terms of solutions, and about 5 billion of additional capital to transition or fix some of the issues. But as you can tell, this, by the way, we go deep into each and every one of these sectors. There are different opportunities that exist for investors. Anyway, with that being done, we can take the presentation off. And I'm going to ask each of the panel members now, Anand, just with my screen, starting with you, if each of the panel members could just give us a 1 to 2 minute view, from where they sit on the kinds of challenges and opportunities they see. So Anand, over to you.
Thanks, Vivek. That was a good introduction to the topic. So thank you for taking us through that. So look, Vivek, let me spend a minute on a few seconds on NIF and who we are, right? So we are a unique institution which is sponsored by the government of India, and we have third-party commercial investors like sovereign wealth funds and pension funds, and also multilateral development banks as part of our investor base. So we are all about an institution which looks at generating a financial return, but doing that in a manner where we are very, very focused on social development and economic development, right? So that's who we are as an institution. And when you sort of look at that, and when I bring that to my business, which is a fund of funds, and how we are investing with third-party managers, we are looking at sustainability and development across a wide range of sectors. So climate is obviously an important area. So one of the largest investments we've done in our fund is in a climate fund, which Satish runs. So I'm not going to steal your thunder, Satish. I'm not going to talk about it much, and I'll let you talk about it. But for us, that was a huge opportunity. And like you showed, that energy mix, right? Going from largely thermal to, it's still largely thermal, but over time, over a 15-year period from 2015 or to 2030, that needs to be heavily skewed in terms of renewable energy, and that is what we've created with Satish's fund, and let Satish talk more about it. But through the fund of funds, we also actually back a number of other sectors and a number of other areas. So be it housing, where you have enough sort of opportunities from a water conservation point of view, better construction practices, putting in rainwater systems, putting in smart water metering, or in agriculture, where you could have drip irrigation, and a lot of sustainable practices across the spectrum in agriculture. Pharma is another area we'll invest in through the fund of funds, through our managers. And again, lots of opportunities in each of these sectors to have a sustainable path for development, as well as to make sure that you're balancing out that financial return with the social and development impact. So that's how overall we think about our investments, and how do we deal with sustainability, and how we walk towards a path of the SDGs.
Thank you, Anand. With that introduction, Satish, maybe over to you. You can both respond and provide a perspective to us.
I'll unmute myself, and thanks, Vivek. And thanks, Suni, for that introduction, Anand. So purely from an Eversource perspective, it's not about what a large PE firm should do to address the climate issue. The genesis of Eversource itself was to really address that issue. And so anything and everything which we do is targeted towards two things. First being decarbonization, second, resource efficiency. So from our vantage point, we see a huge amount of opportunity in each of those areas. And that's kind of a satisfaction. What is equally important is that we see technologies evolving every day to make unviable viable, create business models which were riskier earlier, getting mitigated by the IoT and other technology, Industry 4.0, and create businesses which were unconceivable in the past, purely from a risk return profile. And that's a huge opportunity which we see. Obviously, challenges remains, and regulatory policies support is a must in these areas when we trading a new path and when we are evolving a new scenario. And to that extent, there's much more which can be done to really help the cause. And maybe India should negotiate hard at the COP26 to try to get what was promised in general to the developing world when the Paris Agreement got into the being, and which was a technology transfer, which was a support in terms of financial support. And these are two key objectives which we need to meet for ourselves to really accelerate the path. And I'll talk more later in relation to the specific questions, what we actually do in decarbonization and resource efficiency.
Thank you. Thank you, Satish. Maybe Harsh, over to you.
Thanks, Vivek, and thanks everyone for being here. It's a very important topic, sustainability. At CDPQ, just to introduce CDPQ to all of you, we are Canada's second largest pension fund. We manage close to $350 billion of assets worldwide. Fortunately, in 2017, we were the first Canadian pension investor to actually take climate as a very important goal for our investment activities. So what we actually decided at that time in 2017 is by 2025, we will reduce the carbon intensity of our portfolio by 25%. So that's the goal we took. And this was just not a pledge we took, like we mostly see, but actually we imbibed it internally as well. So what we did are two important things. One is that in any investment decision, carbon intensity has become a very important line item, which the IC has to see. And more importantly, what we did is we actually linked bonuses of everyone to the carbon intensity of the portfolio. So if you've taken a target of carbon intensity of your portfolio by the end of the year, if you have not achieved that target, your bonus gets impacted. And frankly, the results have been very, very encouraging, more than what we expected. So we said by 2025, we will reduce the carbon intensity by 25%. Actually, by 2020 itself, the year which went by, we have reduced the carbon intensity of our portfolio by 38%. So that's the result we have been able to achieve. As we speak today, the low carbon portfolio of CDPQ is close to 10% of our AUM. So that's a big step compared to what we had done in 2017. But going forward also, we are looking at many such areas. We are even going deep into new emerging technologies like EVs, as well as, we are building a light train in REM, which in Montreal, which will also help reduce the carbon intensity of transportation in Montreal. So lots of innovations happening, and a lot of policy work also happening, which CDPQ is involved in. So overall, I would say from sustainability perspective, we are looking at carbon excellence. We've now actually taken a pledge of net zero from our portfolio by 2050. So hopefully we would achieve it much before 2050, but that's what we are going for. Just to respond to your point on Vivek, the opportunities the way we see, and I'll actually share a personal anecdote here. So, I was preparing for this conference over the weekend, and my daughter was very curious. She's 9 years old, and she said, "What are you, talking about?" So I said, "Sustainability and climate change." So she said, "You should also talk about the 17 SDGs." Then I quizzed her for 5 minutes. What does this mean? And she knew a lot of it. So the reason I'm sharing this story with all of you is I feel the opportunity is immense. There was a survey which World Economic Forum did. I think it was in the press yesterday. Almost 71% of people who they surveyed, so they actually surveyed 20,000 people across the globe. 71% of the people said that we are willing to pay more for sustainability driven things. So you look at it, a young girl is already aware about sustainability. People in surveys, and by the way, emerging countries were the percentage of people responding to positively on this aspect was higher in emerging countries, India and China, versus in developed countries. So the demand actually is coming, and if demand is there, then opportunity will of course come. So that's the lens I would look at sustainability from as well.
Thank you, Harsh. That's very, very helpful, and I think very telling about what happens when our generation sort of chances upon something we should have focused on many years ago, and the next generation is now very, very focused on this. Ankur, maybe over to you, right? Very exciting. TPG has gone out and announced a $5 billion climate fund. Lots of excitement around it. You've been leading the charge here in India. Maybe a few words from you on the way you see the opportunity.
Sure, no, happy to. And look, let me first probably synthesize some of the points that my panelists have made, and I'm very consistent with how we think about it, right? I would say there were 4 forces around us that were lurking around us, but had not really reached full potential, right? Number one is net zero pledges, right? We've all heard about net zero pledges. There's $30+ trillion worth of government net zero pledges that have been committed, right? Let me repeat that, $30+ trillion. There are 1,500 companies globally, including over 50 in India, that have made net zero pledges, including Reliance, Tata, Infosys, HDFC Bank, so on and so forth. I may be controversial, but I can assure you, not one of them can give you very high conviction and articulated, say how they're going to do it and where is the money going to come from, right? That's force number one. Force number two is consumer momentum, right? Like Harsh said on the survey, over 50% of incremental consumer demand in CPG companies globally is coming from sustainable products. So the consumers are saying, and they're putting money where their mission is, right? And they're actually putting money behind this. That's number two. Number three, technology has really led to resource efficiency and making this economically viable, commercially viable and attractive. Solar costs have come down over 90% in the last decade. Battery costs have come down by over 70%. So what used to be run by subsidy and by mission is now run by pure fundamental commercial economics and returns, right? And why is that important? Because one is the need side of it, and we all recognize the need side of it. But there's a flywheel here. When investors like us see the need and the opportunity, that's where capitalism comes to play. That's where people want to deploy significant amounts of capital to not just solve the need, but also benefit from the opportunity. And this opportunity comes from actually economic returns that investors can make. So we as TPG see that there's actually a very viable ecosystem that thrives of all sorts of capital providers, whether that's concessionary capital from governments, whether that is debt, whether it is long-term sovereign capital, whether it's private equity kind of capital, which helps build businesses. Everyone has a play to make here. And there's an opportunity for all of us, given just the demand or the need that exists and the opportunity that exists in front of us. Right? And let me probably take 30 seconds more to kind of say from a TPG standpoint. We saw this 5 years ago with Impact, and we started the RISE Fund. We've seen this with the climate change effort, and we started the RISE Climate Fund. we knew we had to bring the intersection of talent, expertise, and policy, right? Which is why we got somebody like Hank Paulson on our board of the Rise Climate Fund to lead the fund along with Jim Coulter. And we made investments like, Element. Element is the largest carbon credit issuer in the world. Now, that's not typically you would find, concessionary capital, sovereign capital going behind. EVBox, the largest EV charging network in the world, right? Fourth Partner Energy in India, which is the largest CNI solar developer. So we see these as, there's a continuum between venture capital and public capital, which has to be all filled to solve for this need and opportunity. And that's where we all come into play, including TPG and the Rise Fund.
Thank you, Ankur. And Gaurav, over to you. I think you bring a interesting perspective, having worked at the intersection of, in a sense, government and private equity and all forces that impact policy in this space. Maybe a word or two from you as the way you see it. Following your response, I'm going to throw 4 or 5 questions to the panel and then open it up to Q&A. So Gaurav, over to you.
Great. Thanks a lot, Vivek. And I just want to open by thanking IVC as well and the sponsors, and also sort of make an apology for this all-male panel. From the vantage point of the United Kingdom government, who's working in and with India, we can't not talk about the COP26. And the COP26 president recently noted that we're all going to have global emissions by 2030 if we have to keep the 1.5 within reach. And our foreign secretary has also recently sort of said that tackling climate change is one of the greatest threats of our time. And without action, it has the ability to push 100 million people below the poverty line by 2030. So what this means is that there's an urgent need for all of us and for the global net zero, for us to shift to a global net zero economy. And that means there is a lot of opportunity in terms of the new economic growth models across industries and sectors. In India, what we do, and you did talk about what we work in India briefly. So we work with India and some of India's apex institutions. And a significant portfolio of ours has also been climate from a very long time. We have some large ticket LP sort of investments where we work with the NIIF and with Eversource. So Anand and Satish are great partners. We have some others where we work with the smaller ticket size range, like the NEEF fund with State Bank of India, where now they are taking it to a scale with their subsequent funds as well. And then we also have another big area on startups in that sense. And I'll just touch on that in the opportunities. The instrument mix that we have is actually a combination of investments plus technical assistance. So we think that we offer technical assistance because it's important to learn from the investments. And there is a sort of closed loop that needs to go to the policy makers. And I will try and answer that question, or dig into it a bit later as well. The biggest opportunity for India is that we are at the next stage of a massive growth cycle, and much of India is yet to be built. So there's opportunity in every state, every sector, with different risk appetites that different kinds of investors would want. And to top it all, there is an unprecedented innovation cycle. When I talked about startup, it was about how there are so many disruption-driven, low-carbon business models which are replacing incumbents. So huge opportunities, and the first movers definitely would get it. And I was so pleased to see and hear Harsh talk about how they assess the net zero for their own portfolio, because I think this is really important. So I'll conclude the opening to say, it's really important to think scale, think new, think disruption, and think global, because India can really set the trend for the world. Over to you.
Thank you. Okay, I'm going to press this panel a little bit on specifics now, so we can go from, I think, what is clearly an opportunity that people have realized and a lot of capital is mobilized behind, to the real opportunities and challenges in some sense. And I'd actually like to first take the first question to Anand as sort of an LP, right, in the space, and others should feel free to add. Anand, how are LPs thinking about expectations of GPs? What measures are they taking to reinforce those expectations realistically?
Vivek, that's an excellent question. Okay, so look, let's step back. Let's step back into what kind of LPs are coming into private equity funds, where all LPs at large scale. So you have a mix of pension funds, you have a mix of sovereign wealth funds, you have multilaterals, and these are the class of investors that are normally coming in, all of whom come in with expectations on what they'll broadly call ESG, right? So ESG and impact, big area of focus for all of these types of investors. 10 years ago, ESG would mean actually having a checklist, having a policy, and making sure that compliances happen with reference to that policy and with reference to that particular framework that you've agreed with investors. And GPs would focus on making sure that there are compliance and all the requirements of the policies are met. Today, if you look at what are LPs' expectations from GPs, I think it's a sea change from what it was a decade ago. Today, the compliance is a given. So I don't think we're focusing. So as LPs, when NIF invests into a fund, or our LPs invest into our fund, or large institutional LPs go into funds along with us, I don't think the expectation is what are your policies and how are you going to follow those policies, and show me a checklist with all the sort of right ticks in the boxes. The expectation has gone far beyond. I think the questions now are about what is the real impact you're creating. And when you talk about impact, which are the SDGs that you're ultimately sort of mapping yourselves to in terms of your business activity? It would be different in different sectors. For the fund of funds, when we map it out, we're going to have at least 12 out of the 17 SDGs that we're going to focus on through our portfolio. And that's through a mix of funds that we do. That's through a mix of investments that those funds do. So if you just think about our business for a second, Vivek, we will have about 150 companies in our portfolio over the next 5 to 10 years. And when you think about those spread across maybe say 8 to 10 sectors, that is the opportunity we have. So we've gone from the point of thinking what is the ENS risk, or what is the ESG risk assessment framework, to saying what is the opportunity for impact. So when we look at each investment, when we look at each fund manager, we're actually talking to them about, tell us what impact are you going to have through your portfolio of investments. For some, it could be affordability and access to healthcare, like our healthcare fund does. In Satish's fund, clearly it's climate, and that's very well. We don't need to talk about that more. That's very well understood. But he's doing that through not just renewable energy generation, but he's doing some really interesting stuff. Waste management, water treatment, all of those are areas that are fitting in finally into our portfolio. We have a housing fund that's focusing on affordability of homes. But while they're building homes, they're also focusing on areas like, how do you economize water usage? How do you prevent wastage? How do you put in the right rainwater harvesting systems? So all of these, which then ultimately go back to climate mitigation. So I think the expectations have gone from mainly policies and procedures to what are the real actionable items that you're doing, and what is the outcome of those actions you're taking through your portfolio. That in my mind is a big shift that's happened.
We open that question up to others. Anybody else?
Now, maybe I'll add a few aspects, and I think Anand gave a very good overview of how LPs are thinking about sustainability at broader level. I think the one myth which some people encounter is that sustainability is a separate fund, kind of a concept which LPs are subscribing to. That's no more the case. Actually, sustainability is becoming mainstream. So if you are investing in any fund, we are looking at you have to make money, as well as you have to make sure that the companies you are investing in are sustainable. And the definition of sustainability, like Anand said, is also getting wider. And so earlier it used to be something like only, okay, if you're saving carbon, that's perfectly fine. You're not investing in thermal, that's fine. So it's becoming more sharper in terms of what are the targets you are going to achieve with your portfolio, in terms, like I said, the carbon intensity of your portfolio. And more broadly, at least for CDPQ, we are coming out with very firm targets in terms of, let's say, how many female employees would you have in your investment team? So those, so the diversity aspect is also taking mainstream. And that's when I said sustainability is becoming wider and very, very result oriented for fund industry.
Thank you. Let me just go to the next question. Ankur, let me direct this to you. What are GPs doing to respond to some of these measures? And I know, of course, you're very focused on sustainability and climate transition in your current role. But if you look beyond that, right, you've always had a portfolio in the growth fund. What are you doing to respond to these measures? Are you building capabilities in-house? How are you preparing, the private equity fund, if you will, 3.0 for a world of climate?
That's a great point, Vivek. And as Harsh rightly said, right, there is clear need for specialized capital, but it's not about specialized capital, right? For ESG, climate, diversity, all of these very important topics. This has to become and has become a way of life, right? Part of our DNA. So like, Uni was saying or Harsh is saying, look, our LPs are asking us the questions. We are asking these questions of ourselves and our portfolio companies. And these really, come in 2 or 3 aspects, right? A, is there a mission alignment? Are our current and potential partners aligned on the mission to say, we're going to make financial, or we're going to deliver good financial outcomes, but not at the cost of the environment or the society, number one. Number two, does it make good commercial sense, right? And I think everybody was mission aligned, but making good commercial sense is just catalyze that effort, right? And third is just discipline and rigor, right? You cannot do this as a board level conversation or just doing it before you make an investment. I can tell you that we are getting to 100%, but 80% of our portfolio companies now have a dedicated ESG officer. That was not the case 5 years ago, right? Like Harsh, right? I can tell you as TPG, we have KPIs aligned to diversity, aligned to ESG commitments in our portfolio companies and in our teams. So it is ensuring there's mission alignment, there's discipline and rigor that's put into kind of monitoring it and implementing it. And I would say at the same time for portfolio companies, it makes a lot of economic sense, which just helps our cause, right, collectively to get this implemented on the ground.
Thank you, Ankur. Others?
Satish, I think you're on mute. Yeah.
Muted myself. Thanks. And probably I'll add to what Ankur said, and well said, Ankur. I'll say that at Eversource, we have a kind of an advantage of having no legacy or no baggage of an existing set of funds or otherwise. So we can actually jumpstart many of the things which people have to transition in some manner or other. And so we had a good fortune to really start from a recruitment itself. And today, when we recruit, in the past, we never thought and we never asked anybody how do they relate to sustainability, what they personally think about it, how aware they are about the concept, and how wedded they are. Today, that's an integral part of our recruitment screen. A brilliant guy, great academics, great track record, but poor knowledge around this, not a fit for us. And that was never the case in the past. So that's the starting point when we build the team. The second thing, when we look at skill sets, we all know private equity business is a long-term business. You require a multifarious personality. You require ability to plug in into different areas and put it together. But more emphasis has come now in our system to see a skill set of synthesizing technology with the brick and mortar. Now, people who can relate to that and who don't see them to be two different cubicles or silos, but see them as an integral part of a cyber physical world, are the people which we again look upon. And that's what we like to see in our conceptual thinking when we talk about businesses as such. So that's again another change which has happened and which helps us in terms of really marrying it and making it much more viable, which was supposed to be a kind of a difficult proposition in the past. The third being obviously the ESG part. Every company of ours without fail has at least one ESG personnel. And there are companies now which has got more than one ESG personnel over there because the scope of the work in relation to sensitizing people at the ground level, be it a contractor, laborer, be it an outsource agency whom we are talking to, where we have to enforce what our requirements are, has become very large. And that requires a different kind of a workload at this juncture. And forget about the workload which will come into the picture in terms of when the carbon gets monetized and you start looking at actually measuring these impacts and trying to convert into a monetary revenue stream for yourself over there. The last thing I'd like to talk about as a GP, which we have done, is again the significant tweaks in our processes, where right from the trial stage where a deal gets entered into our deal hopper, and we do a first step in terms of whether it is something which we need to progress further or not. The whole environmental and social angle and the climate angle is a part of the trial itself. So though no-go decisions are based on whether it is going to have any kind of a positive impact on climate or not. If it is not, then it's not the deal for us. It can be done by any other fund as such. So those are the kind of things and changes which have happened as a GP, thanks to Anand and our Gaurav equivalent, making sure that yes, we deliver rather than just comply.
Thank you, Satish. I have 3 more questions for the panel. I'm going to ask them I'm going to ask each of the people to respond. I won't open it up to the rest of the panel, but Satish, I'm going to keep you in the hot seat right now. And after these three questions, we're going to open questions up to the audience, right? So we'll give ourselves 3 or 4 minutes for your responses. Satish, could you just for a minute describe, where the opportunity is, build or buy? I know you've been involved with many businesses and trying to scale them from a build perspective. Maybe just a few words on how you see the opportunity given so many new businesses will have to be built.
Right. So I think it's a great question, and it's a bit of a paradigm shift also. In the past, we all have seen the Indian private equity scenario at least evolve from a minority investment to maturing it to a kind of a controlled transactions in some manner. And controlled transactions were the kind of a virtue and the practice in the Western world. Indian entrepreneurs were never ever comfortable ceding control to a third guy or second guy coming in over there. So we have transitioned that in one way in a broader private equity framework. But when we come to looking at businesses which can have a significant positive impact on the climate and be carbon negative businesses per se, then we don't see many of the scaled businesses in the country at this juncture. Barring one particular arena, which is renewable energy, and thanks to the policies of the government, and thanks to the fact that the Moore's law got applied much better over here, and the prices kept falling in relation to the panel pricing, and the solar power became cheapest source of power in the country today, where the levelized cost is less than 1 rupee. Barring that particular sector where you still have a 40 gigawatt plus capacity operational and you can do some buyout, when it comes to other part of the businesses, be it energy efficiency, be it energy storage or e-mobility or water conservation, adaptation measures and waste management, you don't have scaled businesses in this country which you can do a buyout and can deploy the funds faster. So to us, it's more of a built out opportunity than a buyout opportunity in the country today.
Thank you, Satish.
And that's a huge opportunity in the country today.
That's very helpful. Gaurav, I'm going to send a question your way about policy. I'm going to combine my question with a question that's come from the audience as well, which is, are there real incentives? What kind of things can the government do? What kind of policies will really help accelerate, which ones actually might be getting in the way? Is there, the question from the audience is there a lack of incentives from the government? What's holding the private sector back?
Great. So so I think the first thing in terms of policy and incentives is that there must be a coherent vision that comes for the sector or for different sectors in a way that that policy is not one person sitting behind one desk. It's a lot of different people and different ministries and different regulations and different sort of associations that need to work together towards a common goal. So I think it's about coming and framing with that clarity of long-term visioning or clarity, I think is the first one. The second one, in terms of incentives, is to make sure that there's a level playing field. Oftentimes what happens is that there is not a harmony amongst different asset classes, whether it's on tax, whether it's on compliances, whether it's in terms of jurisdictions, et cetera, et cetera. And we all know that capital is mobile, so it could go into different asset classes, but where is it that the policymakers needed to go to? And therefore, what are the incentive structures that would direct the flow of capital? Because we know capital is mobile. And I'm also aware that institutions like IBCA are active in trying to take the industry representations to the policymakers in that sense, so that there is that predictability as well. I think the other things about policy is also about how can policymakers go in partnership and create alliances, convene to galvanize action. So it's not just about I've set up this policy, but it's also a call to action. And COP26, I would say, is a great example for us, because when the UK took over the COP26 presidency in late 2019, there were some 26% of the countries that represent the world economy who were covered by a net zero target. And now today, that number is almost 70% of the global economy has a target. And I think that tells you how it's about, taking a call to action, working with different stakeholders to try and come together. And similarly, if you are in the PEVC sort of space in India, it's about bringing together the key voices across all the participants. And I think SEBI and other people are trying to do that in that sense. The last, I would say, a role of incentives is also for governments to try and use the public capital. So a lot of governments have sovereign institutions. They have their own sort of architecture, and it's about trying to understand and create the market. So dip your toes in the market, learn how, what are the bottlenecks facing an investor who probably doesn't have the wherewithal to make that case. But go with trusted partners, feel the market, and create a closed loop policy feedback so that you can then refine your policy, because policy is also dynamic, not very static. And I can sort of give you a quick example from a portfolio where I thought this was done quite well. And that example, of course, is on biomass. So we have in our portfolio a company called Prespo, which converts farm crop stubble and residue into briquettes, so that farmers don't burn this. It prevents air pollution, gives them an economic sort of model. And what the company says is Anndatta to Urja Datta kind of movement. But here's more. What they've done now is that they're replacing wood in crematoriums with briquettes. And from the GP, who's the NIFAN, I understand that the municipality used to take about 12,000 rupees a ton of wood. And sadly, much of that we know is illegally procured, which causes deforestation, etc. But this innovative company has now reduced that to just about 6,000 to 7,000. So it's half, and it's also a change in the culture. And I know that because I'm also part of the governing council of an industry federation that has been created to convene this, led by the very able sort of Colonel Manish, who heads Prespo. So that's an example of how we can support action on the ground and then come back up. And the policy objective there is, there's so much on mitigation, but there is so little that we focus on adaptation related activities. And I think countries and economies and India needs to focus on that. And this was an example on adaptation. Back to you, Vivek.
Well said, Gaurav.
Vivek, if I can just come
Yes.
in there and add one more thing. So look,
Yes.
one of the things that we also do as NIF, and the public policy part of it is very interesting, because we have a group which works on policy matters and which acts as a bridge between policymakers and commercial businesses, and that group plays a very active role in helping the government with forming policies which attract investments. So when Satish, for example, is investing in a particular sector, and then you see a policy tweak there can help the sector more investable, Satish talks to us and our policy team, and we work with the government to see how we can iron things out at the policy level, which will make the sector more investable, which will attract more private capital into those initiatives. So I think there is a very harmonious sort of way of aligning policy and capital, and I think for us, we've seen quite a positive intent and action from the government when it comes to these matters.
Very helpful, Anand. Thank you for that add. I'm going to combine my next question, Harsh, to you with a question from the audience as well, which is, there are obviously many sources of capital. This is, as I mentioned, in Europe alone, we anticipate it'll be close to 28 to 30 trillion dollars of capital required. It may require debt, equity, public financing, private financing. I think one of the questions we've also got from the audience members, with all these governments around the world committing capital, making pledges, is most of this going to end up being on paper because we won't get the capital required to flow into climate change investments? Some of these investments will be investment grade. Some of them, frankly, will just have to be publicly funded by taxpayer dollars. Any points of view from you on sources of capital and how to ensure that that capital gets mobilized so we don't slip?
So, no, I think thanks. It's a great question. And first of all, let me take the demand side and then I'll cover the supply side. So, on the demand side, if we see the capital required is, of course, if you take the dollars, it's humongous, right? I mean, even if we take the solar capacity addition in India, we require probably $300 billion of capital, roughly, for achieving our target by 2030. And that's a humongous amount of capital India needs over the next few years. Similarly, if we go to the EV market, there's a lot of venture capital which is also required for a lot of technology development, for developing batteries, etc. So I would say that the capital required is across the spectrum, and what I am seeing, at least on the ground, is market is responding. There are VC funds which are focusing on clean tech, as well as pension funds like us who are also providing long-term capital for large businesses. from my perspective, where I see a lot can be done is on the debt side, and that's where we see what India can do on itself is not available. So, for example, the $300 billion of capital required for solar energy, which I just talked about, we'll roughly need $200 billion of debt. Now, give or take, what is actually being funded in India from debt markets would be not even double-digit percentage of it on an annual basis. So there is a big gap which we need to fill. Now, hearing this number, all of us will say, hey, okay, we need a lot of foreign capital for this. Now, while I agree with that, because at the end of the day, the global pool of capital is $120 trillion. Sovereign and pension funds manage close to $40 trillion of capital. So even if we can get our share of GDP, 3%, which is $1.2 trillion, our problems are solved, right? But that's not how it is going to happen. We also need to do it ourselves. So when I said $200 billion of debt capital required for solar energy in India, we also need to see what is the credit outstanding in our country. Credit outstanding in our country is close to $1.5 trillion. And that is growing at least, we are adding at least $150 to $200 billion of credit. So why can't we actually deploy a large part of it to renewable sources? Now, then we need to ask the question, why is that not happening? The answer is there are very few institutions which are doing this renewable energy financing in India from a debt capital perspective. IRIDA is one of them. Then there are a few NBFCs, and that's about it. NIF is also creating a platform. So I think, and then when I go to talk to PSU banks, they are sitting on a lot of money, but they don't know where to deploy. So what we need to do is create incentives for these institutions and training. I think training is also a very important thing that we need to do so that we can get credit flowing to renewable sources. Now, coming to the point on question which audience asked, it's a great question. And, practically, all of us feel that, if a pledge is made, things will not flow into, and those kind of things do happen. But what I feel is two things. One is this time the pledges are far serious, and because there is a lot of conversation happening around what are countries actually achieving in terms of the targets which they are setting out for themselves. So it's not just empty rhetoric which countries will be able to get by with. Coming to the second aspect, okay, the money will come from government, but then would it come to India? I feel a certain percentage of it will certainly come to India. Of course, where government is just giving subsidies, we won't get a lot of it because the government would want to invest it in their own countries. But a lot of the capital which is being committed is also for creating financial institutions, for creating green banks across the globe. And that portion of capital, of course, we can attract India. India can certainly attract. Those are my perspectives.
Well, thank you, Harsh. We probably have time for two more questions before we wrap the session. One of the questions that's come up is a question I think that comes up all over the world. And Ankur, I'm going to direct it to you initially. It's an important question because measurement matters, and there have been allegations of greenwashing, and there have been many concerns around making capital available for all the right reasons, and not using this purely opportunistically. But Ankur, how do you validate the claims made by entrepreneurs and businesses? Are there certain types of external audit or certifications you rely on to determine whether things are in fact moving in the right direction? Over to you.
Yeah, no, Vivek, that's a very great question by the audience. Look, on a lighter note, right? When we started this off as a Rise Fund initiative, our number one objective was that this should not become about giving good money to good people for good causes and feeling good about life, right? And just stop there. We wanted it to be extremely analytical, empirical, impact-based, measurable, right? And I'll give you an example what we've done. So, for example, the outcomes in our Rise Fund, which is our global impact fund, as well as the Rise Climate Fund, are diligenced and audited by Y Analytics, which is an independent, not-for-profit organization that's actually doing it for us and many other global providers of capital. At the same time, we have somebody like KPMG that actually does an audit of our impact claims and publishes what is like a classical annual report, an annual impact report to say KPMG, or based on their audit capabilities, has validated or not the claims that we make and our portfolio companies make. Now, is this unique? No, right? We were one of the first people in the ecosystem to do this. But I would say that as this becomes more and more mainstream, market forces and will kind of ensure that all of us become true to our claims and prove it with third-party validation and not just just independent claims by us or by companies, so that people can actually verify that and feel comfortable about that.
Terrific, thank you. We just have a minute and a half left. So with that in mind, I'm going to turn it, firstly, thank you to all the panel members for their time, for their incredibly insightful and direct responses. It's been a pleasure to host all of you. And with special thanks to IVCA and Shutapa and Akriti and Shreya and others who've made this possible. So Shutapa, over to you for any closing comments you'd want to make. But once again, thank you for joining us, and a huge thanks to the panel.
Thank you.
Thank you so much, Vivek, and to all the speakers. I think we learned a lot, understood the topic much better. And once again, thank you all of you for your time. Ladies and gentlemen who are tuning in to the event today, you are requested once again to kindly exit this panel and join us for the next one, which will start very shortly.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you. Thank you, everyone.